On my mind, gotta hustle and grind. Financial literacy always on my mind. I'm stacking knowledge, no time to waste. Gotta invest smart, gotta keep up the pace. I'm reading books, learning all the tricks, studying the market, making calculated picks.
What's good, everybody? It's your boy Reckless Ray Dinero, and we are back at it again for another bag talk. Before we jump into it, let's get the housekeeping out of the way. For those of you who are just getting in here as you're rolling in, if you're watching this later, you also need to follow these instructions. But for those of you who are rolling in for the premiere, thank you for tapping in. Obviously, I'd be talking to nobody in the ether if you didn't. Also, for those of you who take the time to comment and give feedback, also appreciate that. Make sure to like the video. Also, if you've been here more than twice and you're rocking with me, make sure to go ahead and hit that subscribe button as well. Make sure to turn all the notifications on. I don't spam feeds. You'll only hear from me, touch here and there, unless you're watching shorts and scrolling. You'll see me a few other places moving forward, but I don't flood feeds. So don't be afraid to turn the notifications on. Lastly, I would ask that you guys go ahead and share the video, because if you're getting value, somebody else would get value. There's no reason to be on this financial journey by yourself. The last thing you want to do is be the only person at the table eating. Let's jump into it. So I'm going to give my update. We're rolling into the second to last week of January and December, because I don't believe in waiting for New Year's to start new things. My financial experiments are usually anywhere from 30 to 90 days, at which I kind of get a synopsis, a feel for what works and what doesn't. Obviously, with finances, some of the strategies do take longer. So I'll commit to something for a year. Most of my investments are 5-year minimum plays. Like, there's stuff that I'm planning on holding on to, with the exception of my primary income portfolio, because we do what we need to do in that portfolio because its job is to produce income. But the first quarter of 2026, I was going to commit to testing out going fully invested. Now, there's a couple of caveats here. First and foremost, 100% of my money does not go into my brokerage account. So people will be like, oh, you're not all in. You're not all in. It's not everything you have. Sell your house, whatever. Like, people are so weird in these internet streets, and they say crazy stuff to get attention. And I respect that. That's fine. I say crazy stuff to get attention online sometimes too. I feel you. I'm there with you. I am you. But for me, fully invested is over 80%. And I'm at about, I'm pretty sure that I have my direct deposit set at like 85. I think it's close to 85. So 85% of my money does go directly into my brokerage account. No. It is 80. And I know why it's 80. It's 80 because my thesis is based around Bitcoin. And it is the foundation of how I save. So 10%, almost roughly 10% of my income goes directly into a Bitcoin purchase that we're building a position in to get leverage on. But for me, I'm going to break down how I am going fully invested. So that puts me at about 90% of my income goes into investments. Now, I don't get to leverage the Bitcoin yet. So that aspect of it, that's still being built, but it's important for me that I save in as much Bitcoin as possible, because as I said, we're going to be ramping up the Bitcoin purchases. You will be seeing that on our crypto portfolio updates. We're going to be consolidating down into Bitcoin. I've got everything's on the chopping block at this point, to be honest, because I'm trying to get to that Bitcoin demarcation where I can start leveraging it. I'm also in the process of fighting my way through paying off my consumer debt. So we got a few irons in the fire, and as we're moving forward, we are tweaking the strategy and testing new things. But the first quarter of 2026, where we're at currently, is fully invested. That's what I'm going for, because I see the value in it, and I have enough income being generated to where it's actually an option. So I was like, you know what, let's go ahead and jump off the porch and really, really get in here and test a strategy and legitimately be as all in on it as I possibly can on said strategy, and see how it melds into what my end game is, which obviously is to be fully invested in Bitcoin and be a Bitcoin first from an income standpoint, with Bitcoin as the foundation of my financial structure. The first thing I'm going to say is it is very counterintuitive. It is very unnatural, because I've grown up my entire life. It's like, oh yeah, just set aside like 5-10% and you're good. Oh, 10% and you're good. And it's like, you're setting aside what's left over. And the first thing that you have to understand before, when you start getting to the point to where you're ready to go to fully invested, is you're like, if I'm trying to get wealthy and I'm trying to get to a space, to a state that the average man, the working class, the poor, the peasant, if you would, aren't getting to. Like, we're not producing these results. No one in my family is rich. We are finally starting to get a few high income earners. Shout out to my aunt. She got there first. She getting that good money. She worked hard to get it. She's really good at what she does. I'm following up behind her. I'm in second place. Second place ain't bad. I mean, granted, there ain't a whole bunch of us, but like, second place ain't bad out of the group that we got. Because like, one of the things that I will say, you call it genetics, culture, whatever, we work hard. Everyone in my family works hard. I've always seen everyone in my family work hard. I haven't ever seen anyone in my family rich, because like, I'm not rich. My aunt's wealthy, getting there. She's definitely high income. But like, we're not in that level of opulence to where everything's okay. Like, it's still touch and go. Like, we're in a very unique state as a family, because we're actually starting to have some catalysts to where it's like, hey, like, we are about to get to a space of generational wealth. And there's two different models that we have. So like, there's actually options. Most of the time it's one person who's doing all right, and everyone else is starving and hanging on to the one person. And what we're seeing, what I'm getting to see with my family, and what I'm getting to take a part of with my family, is there's two of us. Now, my aunt has a family that she has to take care of, so she has like hangers on that she's made. I don't have that problem. I also don't make as much money as she does. And like, you know, like you start thinking, it's like, well, maybe if I did have a family, I would be at that level already, but I'm doing it as an individual with no tethers, no responsibility, and just building of my own volition to hopefully one day have some responsibility, you know? I plan ahead. But with that said, we work hard. I have seen people who I've seen work very hard get to the end of their lives and just really not have much to show for it. I understand what happens when there is a little bit of something to pass on and you do not have a family that's working in lockstep, that's working in accord with one another. And seeing those bags fumbled have like really affected me. So like, I am very structured with most things. But especially when it comes to finance, and those things that are ingrained, I've always gone to places that weren't my family, because like, I can go to my family for working hard. I've had to go learn all the finance stuff and money stuff from outside of my family, from outside of my culture, as you would, from people who didn't look like me. And I was just willing to ask questions and humble myself to get the answers I needed to figure out what we're doing wrong that apparently everyone else isn't. And there's quite a few things that, like, if you don't have money, and I've found out growing up being around other people that it's not just a cultural thing. it's a haves and have not thing. Like there's two lines. There's the group of people who are destined to be consumers and work their whole lives, and you maybe get a little bit of respite at 65 after your knees are blown out, or at 80 when you can't physically do the job anymore. And honestly, I'm seeing a lot of 80-year-olds going into these warehouses. When I worked in warehouses, there were 80-year-olds in there. They're old people that just didn't figure it out, didn't get it right, that have worked their whole lives, and they're working at a job where you actually work hard. Moving boxes at FedEx ain't easy. Moving boxes at UPS ain't easy. These warehouse jobs that people just look at you and they're like, you dusty, they're not easy jobs. They're physical labor jobs. They're not easy. Can a robot do it? Absolutely. Like, that's not even a question. Is it an essential job? Nah. With robots? No. These are just facts. But it's not an easy job, and to be old and have to do hard work, that sucks. I work in half construction, half IT. There's a lot of old men, and they're usually the only ones who know how to do the job right, that are in those construction jobs. And not all of them are owners, and they have to be there. You know, like, and I don't want to go down that road. Like, I'm fine working hard, but I don't want to have to work hard, and I want to be able to take rest and take care of myself, and at my behest. I don't want to have to ask. So along with that, we're taught 10% you're good, 20% you're good. Those of you who are doing in the fire, you're like 20, 30% you're good, but you guys all make way more money than I make in my W-2. So like, you guys just have more money to throw around. Which is cool. Like that's also something that you get to deal with. I don't have student debt. I have consumer debt. Like my consumer debt is predominantly tied to me buying assets. Totally different focus. But they teach us the 10%, the 5%. You just got to set a little bit aside, get yourself a financial advisor when you don't have any money to get mediocre returns, just like the people who have a bunch of money where a mediocre return is still something noticeable. Because if you got $1 million and you're getting 3%, you can be happy about that. If you have $1,000 and you get 3%, that's like kind of like, what's the point in doing it? Which is the issue that I've always run into when it comes to saving money. And I'm realizing now that I'm getting some motion in my finances that it wasn't actually that I wasn't disciplined enough to save. I just didn't see the point in it, because I've always known that like 3%, this ain't the 50s. That's not money. And I know it's not money. And me knowing that it's not money, I can't get myself psyched up in my head to want to be a part of that. Like it's like, why am I doing this? I could just spend the money and be happy right now. YOLO, right? Is that how you get rich? Absolutely not. But I just couldn't mentally grasp not seeing my money grow. Enter Bitcoin in 2013. Once I started seeing my reserves, my cash, my saved energy actually grow, once I started getting a taste of stuff getting less expensive every year, every 4 years, every 5 years, now over 10 years, that's when it's set for me. I was like, oh, okay, there's something to this. That's when I started fully going in on crypto, because that made sense. And then I found out about high yield, and I was like, well, I am not in a place to where I can both live off my Bitcoin and have my Bitcoin. And I don't want to make the sacrifice of giving up the Bitcoin, because I understand what that is, the economic fuel that is. So I started dabbling with high yield income, a little risky, a little bit of management, thumbing my way through it. I've been doing it for over a year now. So I got that under my belt. I got like a year of experience. I don't have like over a decade like I do with cryptocurrency and Bitcoin, but the principles for what I'm using high yield for, pretty much the same. And then I'm adding in the long-term investment piece to have something in the brokerage account to spend before, or to actually leverage before I have to go to the Bitcoin. And here we are. And the decision to go high yield is it flips everything that we're traditionally taught as working class, poor, peasant. I mean, we might as well call it peasant, the way that we're doing stuff, because it's like we see a handful of people get results, and that's the reason we think that everybody has to be a basketball player, a movie star, or some sort of commodity for people who actually have money. The ideology behind high yield is you put everything into your investments and then pay your bill leveraging the investment. Now that's a drastically different than like invest what's left. Oh, invest what's left. And if you don't have enough money to invest, you just got to go work harder and get more money. Totally different, flips it on its head, because it's like, well, every dime I have come in goes into investments now. Every single one of them. And instead of paying all the bills first, I pay all the bills last. Now, do I pay all the bills? Absolutely. I'm not skipping bills. But it's that thought process that when the money comes in, the first thing we do is expand our asset base, and then we borrow against the asset base, or in my case, utilize the income stream the asset base produces to then pay the bills. And I decided to experiment over the month of December. And so I started doing this, and it was kind of clunky because I wasn't putting every single dollar that comes in. So like now we've got it's changing a little bit. We've got a little bit more to it than what we originally had, because like I started realizing, I was like, oh yeah, I don't have to keep the money for the SoFi loan and the money for the mortgage and the money for the utilities that I pull to sit in a cash pool to pay it. I'm like, well, I'm paying the credit card back out of the margin anyway. So like, why am I pulling this cash over to send to the credit card early when I could just do everything, A, when it's needed, but B, at the end of the month, because I'm cushioned on my mortgage. So every year I pay an additional month out. Well, not every year, because there's been years like the surgery year where I let my cushion get dwindled down because I was injured and, stuff happens and I needed capital to deploy immediately. But I've got, I think I'm 2 months out, and I'm going to go to 4 months. I think at 4 months, if I have a quarter to figure something out, something catastrophic happens, I have the time to figure out what I need to do. 4 months is plenty of time for me. Especially since like we're working towards taking some of these bills, and we're setting up an account to just do our reoccurring expenses. And I'm going to have an account that's focused specifically. One of my portfolios will be focused specifically on those reoccurrings. But December's results were eye-opening for me. So like I got to the end of December. I was like, okay, like I'm kind of all in on this. Like this makes sense. Obviously market dependent, but even in a down market, I still have my margin and it's still producing income. So even if the margin expands, as long as everything doesn't go to zero, which I mean, honestly, if the entire stock market went to zero, that'd be fine with me, because that meant that like everything's burning. So that's not my problem at that point. I got other things to worry about aside from the bills. Like power's probably already off. So moving into January, I was like, okay, so all that stuff will just live in the portfolio and we'll just have that sitting there and in less volatile positions. So that way, if I got to pull cash out or sell something off, I can easily do that, but also expanding my margin so that in the most likely occurrences, I won't have to. And it's been amazing. Now, there's a couple of caveats. So what we're going to do is we're going to look at the portfolio that I'm working out of. I'm going to go ahead and bring that to the screen. Now we're going to have a little bit more portfolio conversation, especially with these check-ins. That'll be more than looking at it at the end of the month. And I'm going to give you the context and the real, because this is what the real numbers look like. And those people who don't show you their portfolios, this is why. So this is my high yield income portfolio, the primary one. This is the one that we're currently existing out of. All the money goes in here. Little bit goes to Bitcoin, and we make moves accordingly, and everything is paid out of here. There are two portfolios we're going to look at, but first we're going to look at the primary income portfolio, because there's some numbers at the top we got to look at. So first off, we got to look at the total account value, which currently right now is sitting at $43,927.16. We have the total cash and investment. We are negative cash because I am currently deployed, because we have paid bills. We did have to pull some out. We had our SoFi loan, which was $1,600. And then we have credit cards that are due, which is a little bit of money. And anytime we pull out of here, I consider that a loan. And every loan that I take, 10% of it goes into Bitcoin. So we pulled a little bit out and bought physical Bitcoin. And that puts us at $2,160.55 in debt. So the total market value of my portfolio is $46,087.71, which is cool. On the day, we're up 2.22%. Now, I am recording this Friday, January 16th, which is coincidentally the day that they pull out the money for my SoFi loan, which went over swimmingly. My cost basis, this is what people will be like, you're just wasting your money, because it's $56,586.74, which puts me at a total gain loss as far as the portfolio is concerned, at a loss of $10,000. Actually, you know what? Let's just round this up and call it 10.5. I'm going to round it up on myself. $10,500. Now, there's some context here. This doesn't calculate the total return. I explain this anytime I bring it up, but for those of you who are new or not in the know or not in high yield, the total return factors in the dividends received. Now, my dividends specifically are not just carte blanche reinvest in the portfolio. Otherwise, the total gain loss would not look like this. It'd look a little bit better. The reason being is we're paying off debt, we're managing bills, we're managing the credit cards, we're doing all sorts of stuff out of here. That's the primary reason. Now, this not factoring in the total return is fine with me. You just got to get used to looking at big negative numbers. That's just what it is. We'll go over the positions, and then I'll give the context. We'll look at my tracking software that I use to track these. But the first three positions in here are more or less cash reserve / margin. I've got 4 of them. So I have SATA, which in the eventuality, quick bit here, as this portfolio grows and we get the income in the space ranges that we need, and particularly when we pay off our consumer debt, we will be moving into the less volatile / less risky positions in the portfolio, which will mainly be our cash reserves. A lot of that's going to be the SATA, these monthly income payers. They don't pay near as much as the other ones, as our other positions that are high yield. These are again, I've said it before, these are my slow lanes up here. The SATA, the STRC from MicroStrategy, SATA from Strive, but they pay monthly. And this is coasting income. This is the slow lane. This is as we're de-risking the portfolio, we put money up in here, and then you're just coasting. A little bit of volatility, not a whole lot, and you're just coasting. Primarily STRC, which is our second position, because we get margin on that. So I have focused on putting most of the money into that position. The SATA is a placeholder right now until we get margin. Now, if once they open up margin on this, which I'm not sure how long that takes, but it is a new product, and generally when stuff first comes out, they do not give you the ability to margin it. Once we get margin on SATA, I'll move more into this because these pay off weeks throughout the month, so you can replicate like what your job income would be using these two tools. Next, we have our first one in here, which is a reserve position for me. Blocks. Now, this position will be running up until we get to about $3,000 in value because I only want at max 10% of cash value in my portfolio. And as it sits right now, we've got about $2,000 more of stretch to buy, and we've got $600 more of blocks to buy unless it continues on its little tear because crypto's doing kind of well right now. But another cash position, we have this set to drip. PLTW, we sold this position off, and then I forgot that I hadn't received my dividend yet. So this is set to drip until we get back up to 1 share to sell it out again. We have Semi, which is a yield boost from Granite Shares. It's a semiconductor based position. I keep trying to buy it, but I have another position that is a little bit further down this list that is, I don't want to say better, but it's a better buy for the same amount of distribution percentage. Then we have TSLW. I am actively buying Tesla. Also, we've got that. We'll be talking about that when we get to the long-term holdings, which is part of being fully invested for me. It's a count. This is part of a swing trade. So during the dips, we'll normally buy TSLW. After it goes up about 10%, what I do personally is I'll start chunking at this, like at 10% in the green. I'll sell off 100 shares and put into TSSY and blocks and YBTY, generally speaking, and probably buy a share of stretch as long as we're not in we're not at our cash reserve limit. And then buy back in on the dip. I've been waiting for a run up. I watched it run up to 10%, missed the sale, and I've just been sitting here on this 400 shares. It's been pretty much flat. The plus side is while it's flat, I'm still getting income. So it's still producing income. So I can't complain. But it's just, not where I should have sold some of it off on the run up and then, put that into another position that would pay a little bit more as we flatten back out. And then I've got TSYY, also from Granite Shares. Now, this one is the primary linchpin in my portfolio right now. It is the one that pays the bills. And it's the reason I don't ever get to buy any more semi, because they're both at 138% distribution. This one's like under $10. We're sitting at $5.09. Semi is $21. So the amount of income that I can get from this one versus Semi is it's just TSYY is a better buy, and it's flat and paying, and I know the price is going down. I don't like that either, but we're not taking any of this off the table and moving it until it drops 5%. And at the current rate that we're going, it somehow is just not doing that. And I understand, like you're still buying, you're buying the dip. And it's like, well, that's because we're staying fully invested. And I'm like, well, if it's going to be paying 100%, then 138% and Semi pays 138%. I want the 138% off the TSYY because I can get more of it. It's just stretching the dollars further, in my opinion. So we're still buying TSYY. Again, we'll be looking at taking some of this position off the table should we drop in a total return basis. And we're going to get there. And then I've got wpay. I'm kind of sitting on this. The margin's too good for me to clip the position, which is why it still exists, to be honest. Like, that's kind of where I'm at with it. Like, if I had something, if this wasn't going to cause me to have less margin by selling it, I would sell it. And I mean, it's still paying, but it's just a real annoying position. I'm probably actually going to end up buying 5 more shares to round this out to an even 200 shares. But we're looking for an exit on this position. That's what we're doing. I just have to find something to replace it with that pays the same or higher, that gives me the same marginability. Because as it sits right now, this, or actually, once I get my cash reserve position set up, I will probably let this go and put it into cash reserve positions, at least at minimum blocks, because at that point, I'll be utilizing the blocks income in the portfolio anyway, and I'll be able to take the hit on the margin because I don't use that much margin now. But like, the goal is I want to have around at minimum $10,000 in margin, if not more. And right now we're at like 6. And wpay is a good chunk of that. And like, if I moved it, I would be losing 30% of my margin. So I have to get to a point to where I can afford to lose that 30%. And then lastly, we have YBTY, which is the Granite Shares Yield Boost Top Performers. I love this position. I am adding to this position. This position makes me happy. I wish more ETFs had a top performers only exclusive bundle to get into. So this is kind of where I'm rolling stuff. This is an easy buy for me because it's diversified, and I understand diversification only helps when you got something going on. But for me, since I am fully invested, I do have a little something going on, and I want there to be less hard swings, but also keep high income. Because wpay, the reason it's not performing well is because it's all the funds. It's not even, it's just so frustrating to have like anchors that are also dragging to get access and then call it diversification. It's like, well, if you got positions that are getting nuked in there, then it doesn't really help. So let's go back up. I want to show these big red numbers because I don't want people to think I'm hiding stuff from them. You're seeing all the gusto here, folks. This is what it really looks like. We're going to switch over to the context for this portfolio because that's important. Now we get over here, there's some key numbers that we like to look at. And I've shown a lot of people. So for those of you who are in the Wolfpack that have seen this already, that are subscribed, bear with. It's always good to reiterate these things. But there's a few key metrics that we look at here. First and foremost, this is actually behind my brokerage because it syncs in the morning. So the moves and the plays that I made today before recording this are not yet recorded. So this is actually a little bit lower, but I showed you the portfolio that it's tracking. So, you know, this is like a little kick in my shin to myself because it's important to show the context, because these, for the record, people, they can make these up. You can make a prop account in here. You can do that. And you'd be none the wiser because the stuff that you're looking at doesn't say anything different for if I'm tracking an actual portfolio or I've just fudged these numbers and made them up. Just so you know, that's the reason I like to show both, because I want you to know that this money actually exists. It's actually my money, and I'm out here in the same boat you are. I go to work, put my boots on, go put in my hours just like you do. I do not make over 6 figures. And I'm out here doing what needs to be done to get some motion. So the first thing we look at is the total profit. Now, this is factoring in the distributions, which puts me at positive $2,504.22 as it's running right now. The other thing that I find important is the passive income percentage. I look at the percentage because this is going, okay, so based off what you've got in here, this number matters. So like I like it between 80. I like it above 80. Right now we are at 77.75, and that's because we have enough money in here now that we're working on getting our cash reserves set up. We're trying to make some moves, and the reason we do that is in the event that there is a pullback, which we have pullbacks, and some of them are rather jarring and violent. I have the ability to liquidate something in the portfolio that's more stable than most of the other stuff in the portfolio, and I can scoop those dips up should I choose. Now, that's if I want to save a position. Another option that I have is rolling the position, which is you sell off the position, buy into something else that you're going to get a better price on, or that's going to give you more income, and you buy your way out of the dip that way. But now that we're fully invested, I don't even know that I need the cash reserves position for anything other than keeping it so that I can have access to a good amount of margin, because I get paid every 2 weeks. So as long as I'm working, as long as I have income coming in, that goes straight into the portfolio, all of it. So, potato. So we're down to 77.75, and this will change after it updates, but I don't know when it's going to do that. And the other thing that's important that I also look at, and this also changes. So you want to look at, I always check out our goals, because like the goal for this portfolio is to produce $60,000 annually. We've been taking hits. We've been taking some hits this year, as far as like the beginning of this year, as far as the income goes. But what we're looking at here is this, and actually we get to change this now because we're pulling in at least $3,600 a month. So, well, no, I'm gonna put it at 3,000. I always go safe because I have my other stuff for no, actually, it's gonna be 28. I want this to be accurate. We'll say 28. Save and calculate. Boom. And so So right now, with what we've got this year, it's putting us at, we're 58% to goal. So we're down a little bit coming off the end of last year. We did have a good influx of income coming in last year. We're at 34,000, basically like 30, almost 35,000 based off what we've gotten so far this year. So it updates as you're getting paid. And so the other page I look at a lot is this page, which puts us at 2,900 monthly, which is like I need it above 3,000, which I think after we do our next update, we should be back up above those numbers. I just don't like seeing months that come in below 3,000, which is crazy, the stuff that we complain about now. But we're looking at getting that dividend income to grow. And being fully invested, I should have plenty of dry powder coming in because it's most of the money that I make to do that. And then as we're working through, we're paying down the debt, managing the loan that we took that's partially in here as well, and just navigating the market. So now we're going to go back here. Oh, we're making good time. And we're going to look at the other piece of this. And this is going to, I've got let's see, our long-term holdings. So this is my long-term holdings account, which is a little over $2,000. And The one thing that I do that's different than what I've seen from other people who are fully invested is I don't commingle my long-term holdings and my income portfolio, but I'm understanding now why people do. And so what we're going to be doing here soon are the positions that have the ability to be margined within this portfolio. I am going to move over into my primary income portfolio because I'm going to want that margin cushion. I'm going to have set metrics for when we do make those moves. So one of those metrics is going to be 5 to 10 shares, depending on what it is. So like Tesla, because that's a big boy, that's a heavyweight in the portfolio. It'll be 5 shares. But MSTR, Schwab, potentially SoFi, I think they have the ability to be leveraged. Those I will move over in 5 share increments. I will buy and build up in this portfolio those shares, and then I'll just move them over in blocks of 5. Either that or I'm going to turn on margin in this portfolio. I honestly haven't decided yet. No, I'll move them over. But this will be the buy portfolio for all my long-term holdings. And anything that's a long-term holding that doesn't have the ability to be margined, I will just leave over sitting in here because it's just going to be clutter over there. My long-term holdings are as follows. We're going to also have our moonshots in here, but my moonshots are long-term plays also. So first, we have Strive, which we're using their preferred SATA. So that is ASST. That is a long-term play for me. It is sub $1. I am buying up as much as I can. I am gobbling down shares of this stock at under $1. My target for this year is 1,000 shares. We're going to get that easy. We're sitting at 94 cents right now. I bought some more today. We're up 14% on the position. It doesn't give the average buy price. Oh yeah, it does. 83 cents a share is my average buy price. I started buying at 80. Now I do buy in the 90s. But I started purchasing this position specifically when it was at 80 cents. I did have some buys at 80 cents. Next is a moonshot, which is Giant Mining Corp. It's BFGFF. I am planning on putting $100 in here and never looking at it again. Like that's where I'm at with this, and then I'm just going to let it sit there until we get 100%. Once it 1x's, I'll take my money off the table and let it run. MicroStrategy, MSTR, like a lot of these are Bitcoin treasuries. I am a Bitcoin first person, and so this is going to be Bitcoin that I can both leverage against as well. So MSTR is the big dog. We're targeting to get our initial 10 shares that I had, because I previously had 10 shares of MicroStrategy and I sold it off to jumpstart my income portfolio way back when. And yeah, so I got to get my 10 shares back. We're actively in the process of purchasing those shares. I think I'll get another 2 shares before we start working on another share of Tesla, or I'll figure out some way to hash this out. But we bought 1 share today, so we got 1 in there for the placeholder so I could take it off the watch list. And yeah. Next, we have SCHW, which is Charles Schwab. I'm on the platform. I buy a share every month because I use the platform. While I'm actively using it, I'm going to keep buying shares because they're making money off me. I'm using the margin. I'm going to share in that money. I do have this one set to drip because they do have a dividend. Next up, we have SoFi, another financial institution I'm using. I borrowed $35,000 from them and bought a vehicle and then funded my income portfolio so I'd have something to pay for the vehicle, because that's how we do. Also some home repairs. We've got 3 shares. We've made 3 payments every month. Buy another share for the duration of the loan. So I should end up with 24 shares at some point. Next we have Tesla, TSLA. It's Tesla. I mean, I don't really feel like there's much more to say about that. Also, keeping an eye out to see if SpaceX goes public. I'll be having that in here too. This is another one. They do hold Bitcoin, and they do not move in correlation directly with Bitcoin. They have Bitcoin on the balance sheet. So that's a Bitcoin play. That's also a robotics play. That's also AI, self-driving cars, American car company. It covers a lot of bases for me. So Tesla was a no-brainer, just a little bit expensive. That's pure growth. And then I have XXI 21 Capital. That's a Bitcoin company, not a treasury. They're a company. They're planning on providing products in the Bitcoin space, generating money and buying Bitcoin. And I like that. Like, either you figure out how to make money out of Bitcoin to buy more Bitcoin, or you start a business, add value, solve a problem, and buy Bitcoin. We are actively still buying all these positions, actually. Tesla, I have no idea. I don't have a target for how many shares I'm trying to get this year. Nor do I with Charles Schwab, because that's a monthly, or SoFi. 21 Capital, I am trying to get 250 shares this year. That's on my goals list. We'll see how it plays out, because it's a little bit pricey, but they haven't actually started launching shipping product yet. So people are kind of not understanding how this works in comparison to the treasury companies. So we'll see. This is where a lot of the stability in your portfolio would normally come from. For me, it's also going to be that, but like, again, like I said, we're not moving these over until we get chunks of 10 shares for the ones that are sub 200. If it's over $200, it'll be 5 shares. And basically that's what's going to provide the additional margin cushion. Now, I try not to use any more margin than I need personally. And honestly, if I can run flat cash, if I get my distributions high enough to run flat cash, which after my consumer debt is paid off and we get to a point to where we can start redeploying, we should be borderline almost able to run flat cash. Like, that's going to be the goal. So I've got a little bit more time here, and there's a couple of things I want to talk about. So the first thing is, when do you go fully invested? Now, for me personally, at least in my specific situation, the thing that made it so that I felt comfortable doing that is specifically when I had, and this was when my margin was higher, but when I had $10,000 in margin and I had over $1,000 coming in a month in distributions. That's when I technically could have started mulling around going, actually, no. I would say $10,000 in margin and $2,000 a month would have been my demarcation point for when this would have made sense. Because at $1,000 a month, this wouldn't have made sense, because I would have just been completely running into the margin every month. But $2,000, I could have made that work, because that's roughly $500 a week passive. That would have been constantly eating down the margin. The other thing that that I think is important is, for those of you who are going to regularly be riding margin, if you're doing this, is to call and negotiate down your margin rate. I know that there's another creator who I follow that's out here that uses E-Trade, and he was talking about his margin interest was at like 8%, and I'm like, Robinhood has 5. Like, either move the money or call them and be like, Robinhood has 5%, like lower my margin. I am guilty of this as well, because generally speaking, if you're not holding margin the same amount of money, because like mine pays itself off, like I'm paying off chunks of it and then redeploying it regularly. So I don't, it's not even something that you really notice, because on my credit cards I notice those interest payments, because they're those finance charges, because they're like, hey, this is a chunk of money. It's never a chunk of money when I'm looking at my margin account. It's like, your margin, we charged you $1 for the privilege of using all that money for that week. And you're just like, oh, okay, like whatever. But it could be 58 cents or like 20 cents or whatever. And every little bit matters. And also you're just getting, you're wasting money. Because me personally, I also have a Robinhood account. I'm not currently using it. It's not the focus for right now. Like, we're getting real dialed in and real focused. But like, I have it. So like, I'm like, yo, like if you don't want to like drop this rate, then I'll just move all my money over to Robinhood and just do this over there. Because at this point, it doesn't matter when I get the money, because like I can get it the next day. I don't care if it comes in late. It's paying off a margin. So, and also, Robinhood gives you the first $1,000 of margin with no interest on it. So, like, that's also a thing. Like, you know, like the more I think about it, the more I'm like, maybe I should just put the primary income portfolio over in Robinhood. Oh, I don't. Oh god. Okay. So I've got to call my I've got to do that. I've got to get that on my day list. It was not on my day list today, but I'm going to have to do that, because me and Schwab are going to have a talk. So that's when I would start, is when I had the ability to have, and I don't even know that you need 10,000, because I don't have $10,000 in margin right now. I've got like 6. And that's because I'm using the super high yield stuff. So a bunch of those positions that you saw in the primary income portfolio, I don't get to pull any margin. The maintenance on it is 100%. Like, I don't get to use any margin on any of those positions, but they do all the work. They pay the margin back. So having enough margin to where you're not using all of it. And I mean, you could ease into it as well. Like, that's another option, is like, you know, build the account up and start pulling. Well, you can't go fully invested though, because you still got to pay the rest of your bills. So yeah, I would say you have to have the income coming in to where you can cover your bills. Now, for those of you who don't have bills, if you don't have debt, then you can go fully invested like today. It's just like, hey, it might be a few months. Like, if you just grit your teeth and only pull your spending money out of it, you go fully invested right now. If you only have a couple of bills, you go fully invested darn near immediately, as long as you get in there and get a good foundation going to where you're going, oh yeah, like I've got expenses of $400. Okay, cool. So your target's basically going to be what that is, and you can just run flat cash. You don't need to use the margin for that. Dangers of going fully invested. Now, for those of you who have spending problems, this is probably not the strategy for you. And the reason being is you now have a new way to go in debt that doesn't affect your credit. Like, that's just the reality of it. And if you're constantly overspending and constantly doing these things, even with the income coming back in on the back end, you're still digging a hole you're not going to get out of. And eventually you build out your margin to where you're in margin call territory. The market goes against you. Now you get margin called. Now your income's hit and you get margin called. So like, you've lost the assets, you get margin called, and this is like a vicious cycle, and you spend too much money. That's not who this is for. This is a tool for people that are financially disciplined and looking to maximize their income. You could also if you're a super high earner, you could also just do this. And because I understand a lot of people talk about taxes. Now, if you're not a high income earner, this really isn't a conversation you should be in, because I'm not a high income earner. And trust me, I'm fine paying my taxes every year because I'm building my way out. But if you're a high income earner, you could do the same thing. You just use the stocks. Or you could set up, honestly, if I was a high income earner, I wouldn't even do this. I would just set up on Strike and buy Bitcoin and then borrow against my Bitcoin and then pay back the loan. Like, I don't know. But yeah, like that's so far. So like I'm going on almost 60 days. And every week it gets a little bit easier. Managing the account's always been easy. You know, seeing the income dip at the beginning of the year, wasn't necessarily expecting that, but like I also don't spend that much time paying attention to traditional finance. So, you know, I'm like, okay, the income's dwindling, but then all the stuff is on the growth side is growing. And you're just like, okay, so the portfolio is just a little bit of a weird space. So I don't know if that's a trend. We'll see what it looks like next year, because it's like the end of the year. It's like you have these like blow off tops for stocks and all this stuff. And so covered calls make more money. You're just making more money off options. Bitcoin did not have a good end of the year last year. So the income actually made up for the fact that Bitcoin was just getting beat on, and I got to buy some extra Bitcoin. We're still under 100K, still buying now. And the income is providing that, because every time I pull out of the portfolio, every time I hit that margin and take that loan, I go 10% of it's got to go to Bitcoin, add a 10% to it, and there we are. So as far as we are sitting right now at almost 60 days, this is looking very interesting. The portfolio updates at the beginning of the month are going to start becoming pretty interesting. The financial updates at the end of the month, or at the beginning of the month, I should say, are going to start becoming way more interesting. We're going to have a little bit more in regards to Bitcoin buys to talk about on the crypto portfolio updates. Also interesting. We're going to be doing this for another 2 months. And then honestly, at the rate that this is going, this might be my new standard until we move over to being fully invested in Bitcoin, because you just build the portfolios up and just keep on trucking along. It's like, it's the natural progression of things. And you know, it's once the ball starts rolling and it starts feeling like you're rolling downhill, like that's when stuff gets fun. Like this is becoming fun. And I'm going to leave it at that. Do not forget to like, share, and subscribe. We will be back next week for another bag talk. It's your boy Reckless Ray Dinero, and I'm out.
Money on my mind, yeah. Focus, got no time for games, nah. I don't play, man, I'm all about that financial literacy. Investing in my future, building generational wealth. Dollar bills, they be calling my name, but I ain't chasing fame, I'm chasing change. Learn the game, now I'm playing it smart. Putting my money to work, it's an art. I'm stacking paper, building my own empire. No more living check to check, I'm getting higher. Investing in stocks, real estate, and more. Gotta secure the bag, that's what I came for.